Balkrishna Industries. Now, they have had a stupendous run lately, but the party is unlikely to continue. The management has thrown light on a number of risks that are emerging for the company, which has prompted the tire maker to turn its focus to India from its export markets. The reason why we are bringing this to you on First Word is because Darshan Mehta has gone through the annual report and gotten us some key takeaways, not something that we usually see. Darshan, what prompted you to look at the annual report of Balkrishna, and what are the key takeaways?
Yeah, so what prompted me was the fact that they've turned cautious on the export market, and for a company which for whose 85% of the revenue comes in from the export market, that's very, very sizable. Balkrishna has always traded at a premium to the other tire makers, given the fact that they are into the off-highway tires and they have a substantially superior margin. Now, what they've said, basically in terms of the financials, 85% of the revenues come in from the export market, and 33% of the revenues is exposed to cyclical risk. That is what the management said. Overall, they're saying that the industry growth is anywhere between 4 to 5%, and it's been witnessing positive momentum over the past 2 years. Right now, it seems to be on the cautious side. Now, one important factor that they pointed out, and I'll name a few, is carbon black, which is one of the key raw materials that they have. There are a lot of challenging in terms of sourcing this. Prices are up by almost 20% in the near term. They have taken risks to hedge this. They've commissioned a plant in India, but that will still come in at the end of the fiscal. So, till that time, they will have to make way with price increase as far as their raw materials is concerned. The other part is the outlook for FY19. What are they saying? That, business environment across the globe for them is looking challenging. They're saying that few of the geographies have now started showing signs of cooling off as far as the economic activity is concerned, and they are endeavoring to promote growth. Probably that will come in this year. So they're not very sure that probably growth will come in. 4 reasons they have stated why the outlook looks bleak and business environment is challenging. First of all is the geopolitical situation across the world. You've seen what exactly is happening. Second is because of the trade tariff and protectionism adopted by a lot of countries. That is something that is impacting them. Rising crude prices and rising interest costs. So these are the 4 factors that they've explicitly put out in the annual report, indicating that these are pressure times for them. But they've also at the same time come out with avenues where they believe growth will come in. First of all, they're looking at the deeper penetration within the Indian markets. The markets in India are just 15% of the revenue, but they want to actually go ahead and expand in the Indian markets. Also, the existing markets where they have presence outside India, they would want more products to come in, deeper penetration apart from it. Thirdly is that they want to extend relationship with OEMs. Caterpillar is one of the big suppliers, so they want to actually do more business with the existing OEMs rather than find new clients, which is becoming tough for them. They want to expand the product range. Anyway, they are into off-highway tires, and that is something that it's a very tedious product. It's a very niche product, so they want to actually come out with better products also here, and they want to take an advantage from the shift from bias to radial tires, and they've already started doing that. So these are the things that they say that they will adopt. But overall, the environment looks challenging according to them global, and if 85% of the revenue comes in from the export market, and they're giving signs that it is cautious there, that's a sign of worry. Just in terms of valuation, one of the most expensive tire companies. No doubt the margins that they clock are much superior than the others, but currently on an FY19 basis, it's trading at, it's one of the most expensive tire companies.
It should be interesting, actually, before I take the next question to Darshan, just bring the YTD performance of all the tire makers. Balkrishna is one, but CEAT and the others, because the others have been under pressure. CEAT, barring the small uptick that we've seen in the recent past, it's come off, as has Balkrishna, of course, but CEAT has come off quite rapidly from the highs that it was trading at to the levels that it is, probably at trading at YTD lows. They also have some export, CEAT does, as do maybe 1 or 2 others. Now, if Balkrishna is finding this market challenging due to trade barriers, I can understand the product is niche, but if trade barriers impact OTR tires, they would probably also impact the normal tires as well. There could be pressures on the others too.
It could. Apollo has a sizable export. That is something I'm sure of. I'm not sure of MRF and CEAT.
Yeah, CEAT has a small exposure.
They may have, but I think the maximum of effect will come in on Balkrishna Industries, because 85% is from there. And you know, most of the tire companies have seen a lot of problems. So you look at the price of, and we were just doing a comparison. C8 was down, Balkrishna was down 3% on a 12-month basis.
Yeah.
C8 was down 35%. So Balkrishna in a way has been outperforming the tire peers, but despite having much superior valuations.
Well, it'll be interesting. Darshan, Sierra has just inked a pact with Tamil Nadu government a week or 2 weeks ago for a 4,000 crore greenfield tire unit, some of it which will be used for exports as well. If these pressures continue, I hope not,
yeah,
for the next few years, you never know what could happen there. But thanks for putting this into perspective. That's one of the best performing tire companies now starting to sound a bit cautious on its key market or the key segment, which is the export segment, because of the trade war fears that are going on right now.